Welcome back, everybody. So today we are going to be going over some stock market data. We're also going to be going over some economic data, obviously macroeconomics, geopolitics, and everything else in between. And I just thought it was quite interesting to go over some charts, what I was kind of highlighting a couple of months ago. I'm just giving you a bit of an update in terms of how I am currently assessing the markets. Now, what I would say is that now, if you do have a question, please leave it in the comment section down below. I do answer every single question. I do read every single comment. And yeah, if you like the video, please like, comment, and subscribe. Now, this chart is the SP500 going all the way back to 1992. Now, the reason why I find this chart very, very interesting, I mean, this is on a log chart, by the way. But the reason why I find this chart incredibly interesting is because the S&P 500 has basically been respecting these areas of support and resistance, or these trend lines, for the last 25 years. Now, if you are doing technical analysis or anything like that, you are probably going to get a little bit frustrated with the lines what I've drawn. But, you know, it is what it is. I have basically just drawn these lines, just highlighting different types of touch points in terms of what the S&P 500 has basically been respecting, again, for the last 25 years. So we are currently all the way up here. And what I was kind of highlighting a few months ago was that we are coming up to an area of resistance here. And as we came up to this area of resistance, I basically took out a 3x NASDAQ short. I was a little bit nervous about doing it, but I felt like it was the right thing to be doing, because at the time I was doing a lot of analysis on the bond market, on the national debt, and I still think that this thesis and this analysis is still how do I kind of explain it? It's still valid today, because the interest rates on the national debt are very, very, very elevated, and obviously the governments can't pay the interest payments on the national debt because of the tax revenues what they currently generate. So I basically, like I said, took out a 3x leverage short. Obviously that did reasonably well. I was kind of expecting us to go back down to this red line, but that did not necessarily happen. And there's a lot of things what were going on as well. A lot of escalations in the Middle East. Obviously, a lot of escalations between India and Pakistan. What I didn't really anticipate, if I'm being completely honest. And I got stopped out of the trade. Well, it wasn't. What do you mean? What wasn't the end of the world, right? But again, I was kind of expecting to make a significantly more money. But again, we are where we are. So if you are kind of interested in terms of how far away we are from this area of resistance, we are roughly about 3 or 4%. To go back down to, let's say, the first trend line, we are basically talking about a 10% correction, then a 20%, 18, 19% correction, and then obviously all the way back down to the lower trend line is about 32, 33% correction. Now, you know, I just find it very, very fascinating just how the S&P 500 has basically respected these lines. Now, you can also obviously overlay over different types of lines, like the 50-day moving average, the 100-day moving average, and the 200-day moving average. Now, I am aware that there is a lot of lines going on this chart, but again, when the S&P 500 basically breaks the 200-day moving average, that typically is a very, very bad indication that the market is kind of falling apart, really. And it would kind of highlight, depending on different types of characteristics, right? I mean, you really want to be breaking these, let's say, moving average, 50-day, 100-day, 200-day, plus you want to be seeing volume as well. Volume on a daily, weekly, and monthly time frame to obviously be getting into these positions. Now, what you can do as well, what I always find very, very fascinating, is you want to be looking at different types of, let's say, indexes in relation to, let's say, gold or Bitcoin or whatever. So this is NASDAQ, what is priced in Bitcoin. Now, as you can pretty much see, that NASDAQ has been going down in value in relation to Bitcoin, because Bitcoin has a finite number, let's say, supply, whereas the US dollar has an infinite supply. So as they start to print more and more money, you basically have more money in the actual system. So let me just show you what I mean. Hopefully I can kind of show you. So if we look at total net liquidity, so basically this is the amount of money in the system throughout time. So obviously when they start to, let's say, reduce the amount of money in the system, that basically means that they are reducing, let's say, increasing interest rates. What makes it what makes it more expensive to service debt, meaning that you are kind of bringing out liquidity from the system. And as a result, you typically see the stock market take a bit of a hit as a result. Now, we see this large divergence. I'm kind of anticipating them to either print more money, or obviously the stock market needs to come down. I do think that it's easier if the stock market does come down for them to print money. You don't necessarily want to be printing money when stock market's at an all-time high. We have large issues with inequality and all the rest of it, and it doesn't necessarily look fiscally responsible. So I think it's quite good how the Fed is basically keeping rates elevated. If I was the Fed, I would probably raise them. I mean, it probably sounds a little bit aggressive, but there's a few different reasons of why I personally would raise them. I would make a lot of countries basically get back into the US stock market, US debt market, by basically raising rates. And the reason for that is because obviously as you start to raise rates, the servicing on that debt becomes more and more extreme. And we see a lot of countries be more aligned with China over the past couple of years. And I think you could basically force that action by basically, let's say, crippling their economies. And you are basically making them choose whether to pick China or the US to be the next global leader. And obviously, if you kind of force that action in the global debt markets, you are basically asking everybody to pick a winner, really. Are you going to pick the US or are you going to pick China? And depending on who you actually pick, you would then obviously buy the debt of that country. And we would see, let's say, more alignment with the United States rather than more alignment with China. Now, I'm not going to get into the ins and outs of all of that thought process because this video would be significantly long. I kind of got into the ins and outs of the of a lot of what I'm kind of talking about in previous videos, but I mean, obviously, if you look at the UK, if you kind of said who is the UK most aligned with, is it more China or is it more the US? I mean, the US might not necessarily be liking how the UK is currently treating its citizens or whatever. So again, you can kind of force the action in the US debt market, in the bond market, should I say. So going back to this, basically, as the stock market starts to, let's say, pull back, you can see they basically intervene and print more money. Now, obviously, throughout time and throughout history, you can basically see we basically track total global net liquidity very, very, very accurately. Now, like I was saying, where we currently are, we have this very, very large divergence, and one or two things need to happen, in my opinion. Basically, the stock market needs to come down, or the amount of liquidity in the system needs to go up. Now, just addressing some questions just in relation to the Fed. The Fed controls the short end of the yield curve. It doesn't necessarily control the long end. The long end is dictated by the market. So, if the Fed does cut rates, that does not necessarily look like a sign of strength. It looks like a sign of weakness. So the Fed keeping rates elevated, in my opinion, is very, very good. Now, just in relation to the 10, 20, 30-year yields, now, obviously, there's a lot of news headlines, and a lot of people are basically saying that the US is massively fiscally irresponsible. Obviously, there is some truth to that, right? And obviously there's the expectation of inflation. Now, there's another dynamic to the yield spiking. There is significant amount of stress globally, in Asia, in Europe, like significant amount of stress financially. And a lot of these countries, they basically own US debt. So if they basically need to prop up their own economies, they are forced to sell US debt because it's the most deepest liquid market in the world. As they sell that debt, the yields start to spike. What obviously hurts the US and all the rest of it. But again, there's a lot of moving parts to all of this. But I just think it's quite an interesting thought experiment. Not necessarily just to, let's say, read into something what you see on Twitter or something what you see on the news. What basically is, the reason why the yields are spiking is because the US is fiscally irresponsible. I mean, the US basically just needs to be the least dirty shirt in the laundry compared to everybody else, and I think they can do it. There's a lot of dynamics, right? There's a lot of moving parts. I mean, I didn't really anticipate them to raise the debt ceiling
obviously everything what is going on, let's say on this island, I mean, I don't really need to get into the specifics of that, obviously could have some implications depending on obviously who is involved in that. So there's certain things what you might have to do, obviously, if you are, let's say, on that list. And again, even getting into all of that obviously has large implications from a stock market perspective, geopolitics, and absolutely everything as well. So, there's a lot of moving parts to all of this. Going back to global net liquidity, what is also very interesting to do is looking at it from a crypto perspective or a crypto market perspective as well. Bitcoin basically follows the same trend as total global net liquidity, because obviously as there's more liquidity in the system, obviously that liquidity starts to spread out across different types of risk assets or goes down the risk curve, meaning obviously people take on more and more risk and obviously do more, they basically seek higher and higher levels of return. Now, obviously this is on a log chart. You can put it on a normal chart and track total global net liquidity, but you can basically see that there is a lot of correlation between total global net liquidity and the stock market and Bitcoin and gold, and it's just something to pay attention to. Now, something else what I kind of want to highlight is the total market cap, excluding Bitcoin and Ethereum. Now, this is called Total 3. Now, over the last month, we have basically seen the market cap of the total Total 3 basically increased by about 150 billion. Now we are currently sat at about 950 billion, so we've gone from about 800 billion to 950. Now, what is very interesting to do is if you divide, or let's say if you look at Total 3 in relation to Bitcoin, meaning you want to be looking at, let's say, dominance. So you can do this in currency pairs as well. So you can look at USD denominated, let's say, assets or indices or markets in relation to USD, and you can basically do the same thing in the crypto markets. So just think of Bitcoin as the US dollar, meaning it has a lot of dominance around the world. So at the moment, if you have been, let's say, buying altcoins or doing speculating on XRP or whatever you want to call it, now I get a lot of heat for basically, throwing a lot of shade at XRP. And, even me just saying it now, I'm probably going to get a lot of people basically say, you don't know what I'm talking about, blah, 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 blah. But just on XRP, there's a lot of insiders who hold a significant portion of XRP, and they basically push a lot of marketing out on YouTube, Instagram, and all the rest of it to basically promote and obviously sell to the public. I don't really like it at all. And that's the reason why I want to highlight it, because I think it is very, 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 very speculative. But basically what I'm getting at is that if you have been buying into altcoins in relation to not buying, let's say, Bitcoin, you have basically lost roughly about 60% of the value if you just, let's say, held Bitcoin. Now, there will become a point where this entire chart basically transitions, and that is obviously when we start to see alt season. Now, we saw it in 2017, 2018, where we saw significant gains pretty much, like let's say in about 6 to 8 weeks. We saw that in 2021, where, we see this large influx of liquidity into the altcoin market. Now, it does seem that the, let's say, altcoin market in relation to Bitcoin basically bottoms out around 0.3 to 0.28. I wouldn't really be surprised that we go down to, let's say, these levels around here. So let's say the altcoins would still bleed back to Bitcoin. Now, the thing is, altcoins don't necessarily need to bleed against Bitcoin, because obviously you are probably looking at it on its USD pair. But what you could theoretically happen is that you could see that obviously Bitcoin goes up in value, because obviously a lot of people are kind of front running it, but altcoins do not necessarily move, because obviously more liquidity is going into the Bitcoin market rather than altcoins, and obviously that would bring down Total 3 in relation to Bitcoin, what would kind of push us back down to this 0.3 area. And like I was saying, we saw it in 2017, 2018. We've seen it. We saw it a little bit in 2019, and obviously we saw it significantly in 2021. But yeah, I mean, obviously, if we go back to the total market cap, obviously excluding Bitcoin and Ethereum. The reason why you can start to see altcoins get a little bit of a bid is because people feel more and more confident in terms of putting liquidity back into altcoins. But when you start to look at the different types of macroeconomic conditions, what we currently got going on, obviously just in relation to the national debt, obviously interest rates, where the Fed is, there's a lot of people kind of trying to front run the Fed into rate cuts. But like I want to highlight, I don't necessarily think that we are going to be seeing rate cuts anytime soon, because again, a rate cut typically signifies that something has significantly broken. Rather than a sign of, like I said, a sign of strength. You typically don't cut rates because things are good, especially at all-time highs. That's just my own opinion. Obviously, if you disagree with me, please let me know why you disagree. Rather than just telling me that we are going to go back to all-time highs in altcoins and Bitcoin and rah, I would prefer to have this discussion about why you think the Fed cutting is a sign of strength. Because in my opinion, and obviously throughout history, we typically have not cut interest rates significantly because the economy is good. Typically, something is breaking. We have large credit events, and this is kind of what I've been highlighting as well on DC Economics on Instagram. Is that there's a lot of things going on in Japan at the moment. If we click onto Japan, let me just remove this global net liquidity. But this is the yields, and the yields have not been this elevated since all the way back into 2008. And the reason why this is very, very, very important is because Japan is significantly in debt. Japan is Japan is the largest holder of US Treasury bills. If they are forced to liquidate, meaning if they are forced to stabilize their own economy and basically prioritize Japan over the United States, they would be forced to sell US Treasuries, and that would obviously spike the yields on US bonds significantly. And obviously we'd have this thing called contagion, where there's a lot of knock-on effects from different types of it'd be a large credit event. And typically what you would normally see is that all assets, or let's say all asset classes, would typically go down in value. And normally people would rush back to the dollar or rush back to, let's say, US debt. And then obviously they can, basically the whole entire, let's say, cycle resets. But until something like that happens, this thing is going to keep carrying on. But when you start to look at this, it does not look good what is going on in Japan. And this could be the domino, what basically sets everything off. I was kind of anticipating that it was going to be more tariffs, what is mainly acting as a stick rather than a carrot. But obviously you can pretty much force a lot of this action by basically stopping people from speculating on different types of risk assets, and obviously get people back into the US debt market. And obviously when people are back into the US debt market, they can basically refinance a lot of the national debt and basically manufacture and do everything back into the United States. Now, what I also want to talk about is the Fed Watch, just in relation to the FOMC meetings in the next 14 days and basically in the next 2 weeks. There's a lot of expectation that the Fed is not going to cut rates. 95% of market participants basically think that the Fed is not going to cut rates. I think that is absolutely true. I think they would only cut rates, obviously, if something breaks. And, where we currently are from a stock market perspective and everything else, I can't really see them cutting rates just because, people want their crypto to basically go up or asset prices to go up. Now, just in relation to the national debt, we did see last week, this has obviously not been updated, this is updated every single quarter, but we did see that the United States basically printed $300 billion of debt, and obviously that added to the national debt. And obviously you could kind of make the argument that, well, that is the reason why Bitcoin is getting this bid and why people are basically going back into, let's say, hard assets. But like what I was saying, and like what I've been kind of highlighting over the past couple of weeks and months, I can kind of anticipate that there will be a large-scale credit event where people are basically forced to liquidate whatever to basically pay their obligations or debt or whatever. And, Japan could be that thing what snaps absolutely everything. Or it could be tariffs again. Or it could be an escalation, in the Middle East, in Eastern Europe. Or we could start to see an escalation between India and Pakistan. And like what I was saying in my previous videos, you want to be looking at different types of networks in relation to TikTok, in relation to Instagram, etc., because that is how predominantly many people basically get their news. So obviously, like with the India and Pakistan escalation, we saw a lot of stress in China. And, I was kind of making the assumption that I don't think it was by any chance that we saw that escalation happen significantly quickly, because Instagram is only in India, TikTok is only in Pakistan. Obviously, you can turn certain messaging up in Pakistan, turn certain messaging down in India, obviously have a conflict. And when that conflict basically kicked off, the US cannot be in another war. It cannot finance another war. It does not have the capacity to basically do it. So obviously, overnight, we basically saw that India and Pakistan basically came to a ceasefire. And straight away as well, we saw that the China tariffs were basically put onto a 90-day pause. From my perspective and my opinion, I don't think that was a coincidence. Now, what I also want to highlight is just in relation to the issues. So we are starting to see the oil prices tick back up, bond yields start to tick back up, obviously the national debt's starting to tick back up. In relation to inflation, obviously if oil prices do start to tick back up even more, we will start to see probably inflation start to tick back up, because oil prices have a massive impact on absolutely everything in terms of transport, in terms of transferring goods and services across the country, across the world, etc. The dollar strength is very, very interesting, because obviously a weaker dollar makes your exports more and more attractive, because obviously you can basically export more and more. Unemployment, obviously having low unemployment is obviously very, very good, but obviously if you have high yields, your unemployment will probably start to tick up, because there's a lot of businesses who will basically focus on debt repayment rather than hiring, because your margins are basically getting squeezed, and obviously interest rates as well. What I've done here is I've obviously just put, obviously if we see a lower, let's say, oil price or a lower bond yield, what is the pros of that? What are the cons of a higher oil price, obviously higher bond price, national debt, etc., and how you can basically address it. Now, what I think the administration is trying to do, and this is the thing as well, like a lot of people basically keep saying to me, well, I keep giving the administration a lot of credit, and what I would say is that I do think Scott Bensent is a very, very, very intellectual guy. I think he does understand how macroeconomics works, because he did a lot of things in Soros Fund back in 1982 in relation to shorting the British pound and currency pairs and all the rest of it. I think he has a very, very good understanding of how macroeconomics works. But basically, if you reduce the oil price by basically, let's say, reducing regulation and obviously increasing the reserve, obviously you can start to increase production, obviously, in the oil, what obviously would bring down the oil price, what would basically suffocate Russia, because Russia can finance its war in the Middle East, not in the Middle East, in Eastern Europe, a lot better with a higher oil price. Now, in relation to the bond yields, I think you could bring the bond yields down by basically, let's say, shaking the stock markets, by basically pushing people back from the stock market back into the US debt market. Obviously, as well, like what I've been talking about for quite a few months is the push towards stablecoins, because stablecoins could be the largest buyer of US debt, and I think that is pretty much going to happen. I've been seeing a few interviews from Scott Bensent just in relation to stablecoins over the last weeks, and I think that is definitely going to happen. Obviously, the Fed could step in, what basically is quantitative easing, and buy the long end. And obviously, if they do start to buy the long end, that is not a good sign at all. But obviously, if you are a retail investor, or if you're managing money or whatever, that would be a very, very, very good time to go heavily into bonds and take on a significant amount of leverage, because the bond prices will pretty much go up significantly, because obviously the Fed is basically stepping in and buying the treasuries. Now, in relation to the national debt, cut spending. I mean, that is the biggest thing. Obviously, you could cut entitlements. I talked about this in my previous videos. A lot of people kind of, got a little bit frustrated with me when I was basically saying about cutting entitlements and the wording, what I was kind of using. But basically, we cannot fund these entitlements. Everyone's been promised a lot of things, and that number is significant, and you really have to really tighten your belt on the spending side of things. And obviously, on the entitlement side of things, I wouldn't be surprised that we start to see the retirement age obviously ticking up. And obviously in relation to the other things, I'm not going to go over that now because this video is significantly long. I was seeing that there's a lot of people basically saying you need to make shorter videos. So, but anyway, you can basically see it on the screen. You can just basically pause and obviously read everything what I've put here. Just in relation to obviously hiring, let's say, putting interest rates higher. The reason, like I was saying to you before, the reason why you do that is because it pulls all the liquidity back to the US predominantly. So it makes the dollar, it makes the dollar. You're basically showcasing fiscal dominance by obviously forcing people back into the US debt markets, and this is what I'm trying to illustrate here. How all the liquidity is basically going back to the US dollar. We've already talked about that. We already talked about this in terms of trading economics. Yeah, this is something what I found very interesting. There's so much stress in China, and people don't even realize it. I was over in Asia. I was talking to people in Malaysia, in Thailand, talking to a few different funds, hedge funds in Singapore, and all the rest of it. And the amount of stress, credit stress, and things what are going on in China is just absolutely insane. And they have obviously, won't be any surprise, but they have obviously raised their debt ceiling. The reason why they do this is because they do not necessarily want a strong yuan. They want a weak yuan because that will massively help exports. And yeah, this is another thing what I wanted to highlight, what is just in relation to the US basically raising its debt ceiling to obviously have more borrowing. Obviously the anticipation of this happening obviously can get basically priced in instantly, obviously in the in Bitcoin, in gold, etc. And obviously if they do start to print more and more money, that is going to distort all asset prices, and we will probably start to see more and more debate around the rich getting richer and the poor getting poorer, blah 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 blah. But like I was saying in my previous video, we don't really look at the systemic problems. What basically is central banks, central planning, government spending. We basically blame the rich, where obviously if you print a shed load of cash, all assets go up, and obviously the people who hold the assets are not really in the best position. But anyway, something to pay attention to is obviously the Japanese bonds, bond yields, and yeah, hopefully you found this video informative. I know this has been a bit of a quick video, or relatively quick. Hope everybody is having a lovely day. If you do have any comments, please leave it in the comment section down below. And yeah, to the 4 people who keep on supporting me, take care. Bye bye.